All right, I think we're going to get started with the second and final panel. So just as a reminder again, as Neil Kashkari had said from the beginning, there's been two sort of reoccurring themes, and I think you heard it this morning as well, that we've heard at the prior symposiums. So one was related to the credibility of a conversion of debt to equity at the point of insolvency. And the second is, if you are thinking about as a reform to address the too big to fail problem, significantly higher levels of capital, how should you think about and respond to the potential that activity that is currently within the banking sector would move outside the banking sector to, there's lots of different names for it, but for simplicity's sake, maybe we'll just call it the shadow banking sector without not meant to cast any aspersions on it. So maybe some people, non-banking, financial sector, et cetera. So again, I think we're incredibly fortunate to have three individuals on the panel who have written extensively about this issue, both in the context of academic articles, articles for the public more generally, and even full-length books on the topic. So I'll do a brief, again, introduction of the group as a whole. They'll each speak they have up to 25 minutes. We'll turn it over to Q&A for the audience. Let me just say the program is noting this as ending at 3:30, but we'll end at 3:10 given that we have three individuals. I think at some point we thought we would have four. And I think this is related to something that President Kashkari said. We're at every stage of this process, we've tried to engage with the industry, have industry reps on panels, have them here, and that's, at times proven to be more challenging than maybe one would imagine. So I appreciate S&P being here for the morning panel. So we have Professor Viral Acharya from NYU Stern. Viral is certainly one of the most prolific academics on an incredibly wide range of issues in the financial sector, from banking capital to policy-related issues following Dodd-Frank, but also related to a couple of articles on shadow banking. Sam Hansen, professor at Harvard Business School, also has written in a couple of different takes on shadow banking, and most recently presented a paper that was, I think, maybe more focused on monetary policy, but at its heart had some of these same exact issues at Jackson Hole, along with co-authors. And again, the full biographies are here. I'm not doing it justice. I just want to give you a flavor for the breadth of the skills we have. And Professor Hansen also spent some time at the Treasury during the crisis period, which is a nice segue to Morgan Ricks at the law school at Vanderbilt, who also spent time at Treasury during that exact period. And the combination of them and Neil, I think we know why we got out of the crisis so successfully, given the skill levels that were brought there. Okay, that was taken as a straight line, and we can move on from there. I won't dispute it. And I think Morgan will be talking a little bit about, again, someone who writes on a broad range of issues related to financial regulation, financial sector, but has most recently, as I mentioned, written a full book-length treatment of that, and I'm sure he'll do his best to sort of distill down the key points of a book in 25 minutes. And with that, I will turn it over to our first speaker.
All right. So thank you very much for having me. I'm going to be talking about banking regulation and the risk of migration to shadow banking. All right, so to kind of put this all in a slightly bigger context about just kind of overall frameworks for regulation, I'm going to kind of start out by contrasting the kind of microprudential framework, which was, I think, kind of the dominant framework in banking regulation prior to the crisis. So in this framework, the idea is that, because there's bank runs, we've given deposit insurance to banks. And the key market failure is because we've given banks deposit insurance, we're really worried about moral hazard or too big to fail. And so, what microprudential regulation was all about, making sure that regulated banks have enough capital to ensure that taxpayer bailouts are unlikely. And there was kind of less focus on regulating intermediaries who we basically thought there was no chance they'd ever be bailed out because they're not subject to this too big to fail problem. And I contrast that with what I would call more of a macroprudential frame on regulation, which I think has become more important and more of a focus following the crisis. And the kind of key goal of macroprudential regulation, as I see it, is to limit excessive contractions in credit following adverse shocks when many intermediaries are hit with a common shock. And so the market failures here in macroprudential regulation are things like fire sale and credit crunch externalities. If you want to kind of have a tagline, it would be there's either some bank or some market that's too important to stop lending, too kind of important for the vibrancy of the economy. And the idea here is, what the market failure stems from the fact that individual financial intermediaries do not fully internalize the threat that they pose to financial stability, and as a result, their collective decisions may make the overall system too vulnerable to crises, and that may be so even if there isn't moral hazard. So this is not to say, I believe that moral hazard is an important problem, but that you can have, significant regulatory concerns even in the absence of moral hazard. And the other thing about this macroprudential frame is that I think one worries about there's excessive contractions to credit that disrupt the real economy. We don't care so much whether that large contraction in credit necessarily comes from traditional banks, the shadow banking system, non-banks, markets alike. What we're really worried about is kind of a punctuated shutdown in credit markets that has a large chilling effect on real activity. Okay. So with that kind of overall frame, what I'm going to basically do is kind of frame banking regulation, kind of have a particular frame for thinking about banking regulation, talk about kind of what the core, what the kind of key market failure is that we're often worried about in banking regulation, and then talk about the risks of migration where we have kind of two different sectors that can actually engage in banking, something that we'll call regulated banks and something that I'll call shadow banks. So kind of a way to frame the underlying problem of bank regulation. The first thing starts with just what is actually banking to begin with. And at least the way that I often think about this is, basically there's a very special demand for financial claims that are incredibly safe, short-term, or liquid, that basically share many of the attributes of money. Things that are like deposits, money market fund shares, treasury bills, the like. So in some sense, the reason for being, or what banks do, are they are the things that manufacture these money-like claims. And because there's a special demand from non-financial savers, from households and for firms to hold these money-like claims, if you can issue money-like claims, they're basically going to be very cheap. So they're going to tend to offer interest rates that seem sort of too low from a textbook risk-return perspective. In other words, they kind of carry a money-like liquidity premium. And this kind of money-like liquidity premium tends to be especially strong for very, very short-term claims, for things even like overnight claims. So this is an illustration of this from some of my previous work. What I'm plotting here is I'm plotting the yields on treasury bills of different remaining maturities in weeks, and plotting the difference between, say, a treasury yield that has 4 weeks to maturity and what the yield is on a 6-month treasury bill. And what this is basically showing you here is that the yield curve is basically extremely steep at the front end. As you kind of get closer to the very, very short-term overnight stuff, there appears to be this very, very large premium for this. And we think of this as arising. This is basically an average over the past 30 years. So this is not like the expectations hypothesis we think the Fed is going to ease. This is kind of how the yield curve looks even in normal times when the Fed is on hold. And I think of this as kind of this very special premium for absolutely short-term safe stuff. As a result, given this very strong demand and basically the fact that issuing short, safe stuff is very cheap for banks, they have a very, very strong market incentive to manufacture money-like claims. How do banks do that? They do that via what I would call maturity transformation. So and this is kind of what the essence of banking is. We're going to use long-term illiquid and risky assets to back claims that are short-term, liquid, or safe. Okay? So this is the good we're trying to deliver. How do we do it? The problem is, and what the kind of the starting point for this kind of macroprudential view is the idea that banks, the way that banks actually create these claims, this process of maturity transformation, can pose threats to the overall stability of the financial system that are not fully internalized. So if you want to think about this as, we're trying to produce a good. Our production process actually emits, some pollution into the air. We don't fully internalize that, and hence we're going to tend to overproduce the good and pollute too much. So, an example of kind of one of these types of externalities, what people would call a fire-style externality. If I'm an individual bank and I rely heavily on short-term runny funding, what that means is there's a bad economic shock, I'm going to be forced to liquidate my assets. That means I'm going to push down the prices of those assets to fire sale levels, threatening the solvency of other intermediaries, and then leading them to contract their credit and exacerbating the initial shock to the overall economy. So, and I think broadly, these kind of failures to internalize financial stability costs means that from a social point of view, banks, and this is even in the absence of moral hazard, may have a tendency to issue too much short-term runny debt, issue too little loss-absorbing equity, and especially as we're talking about kind of in the first session today, once they have a loss, be too slow to recapitalize following losses. They're not internalizing that the fact that they're being slow to recapitalize has very adverse effects for the broader financial system and the economy. So I think, in theory, this is kind of a classic market failure externality. In some sense, what we'd like to do is oppose appropriate regulations on these different intermediaries that would force them to internalize the full threats that they pose to macro financial stability. If we could do that and impose them on all intermediaries, kind of in proportion to the threats that they pose, that would allow us to fully correct these market failures. And in some sense, this is kind of the regulatory ideal of what we're all trying to do. And I think the post-crisis regulation has kind of largely been shaped by this view, whether it's the Basel liquidity requirements, heightening bank capital regulations, and in particular imposing heightened bank capital regulations on the largest institutions, plus forward-looking stress testing, and then also what we were talking about, a sort of resolution of large intermediaries, are kind of all responses to each of these tendencies for banks, to kind of overdo it from a social perspective. So kind of taking a step back from that, and this will allow me to start thinking about now the efficacy of regulation and the threat from migration. At least I like to kind of think about this starting from sort of a functional view of what banking is. So as I said, I kind of think of banking as credit intermediation plus maturity transformation. And the tough challenge that we face, or that regulators face, is that there's sort of there's different technologies for actually kind of performing the same underlying activity, or the same form of financial intermediation. So obviously there are, traditional regulated banks. This is, banking that's carried out by a highly regulated set of institutions that we call banks, which obviously receive extensive public sector support. But at the same point, this activity can actually be done in a different way. So shadow banking, what I think of as shadow banking is banking, which is a very similar economic process that's carried out by chains of transactions involving many different market-based intermediaries who are lightly regulated and receive far less public support. So for example, a traditional bank, they could make, say, a risky loan to a corporation and finance that with some of their equity and deposits. How would the shadow banking system do that? It actually would involve several different intermediaries all working together. But a simple example would be, a hedge fund buys that same risky loan, finances it using the hedge fund's equity and an overnight loan from a broker-dealer. The broker-dealer then uses the same collateral to borrow from a money market fund in the repo market. Either way, at the end of the day, we've taken this risky asset and transformed it, or used part of it to back sort of a money-like claim, something that the household sector will treat as a deposit. And I'm kind of using shadow banking here in this very specific way that it's actually kind of replicating the essence of banking. As Ron said, some people use it more broadly to refer to all credit intermediation that takes place outside traditional banks, but I'm going to be kind of focused on this specific shadow banking sense. Okay. So kind of with that, you can sort of see where I'm going in terms of limits of financial regulation. A key concern because we kind of have these two parallel sectors, is that we heighten regulation on the traditional regulated banks. That's going to lead economic activity to migrate towards the shadow banking sector or other more lightly regulated non-bank intermediaries. The activity has migrated, but the sort of threat that the activity poses to financial stability still remains. So what this means is that this sort of possibility of migration reduces the ability of regulation to correct the underlying market failure and to safeguard financial stability. And to think about why does this migration happen? Well, say if we impose much higher capital requirements on banks or impose liquidity requirements on banks, sort of by definition, we're trying to get them to internalize a cost that they're imposing on the system. So from their private perspective, they will perceive it as being costly. So for instance, they'll perceive it as raising their cost of capital. So you could even imagine a very large increase in capital requirements. It might only raise banks' overall cost of capital by something like 30 basis points. However, if there's this other parallel sector that they're competing head-to-head against, where they're offering sort of a very close substitute in terms of the ultimate product loan to a company, the regulated sector that has this cost advantage, we're going to expect to see business to flow to the other sector where that does not have this cost disadvantage. So the kind of ideal here, and the reason why this arises is ideally, I think, in theory, we would like to regulate kind of financial intermediation on an activity based on its activities. So maturity transformation should be regulated in a similar fashion, irrespective of the type of legal institution that's carried out. In practice, we tend to regulate activities by particular institution types, and that kind of results in this sort of whack-a-mole process where we tighten regulation, activity migrates to a place where where regulations are the weakest, that has adverse responses, and then the regulatory system keeps up. So in some sense, this kind of migratory process I think is a kind of an important limit on our ability to migrate. And you could almost think of it as the kind of analogy would be if you're trying to raise taxes. If the state of Minnesota is trying to raise taxes, and ultimately are competing against the state of Florida and the state of California, which is much different. If we were all 50 states together, we're just setting their tax regimes. They don't have to worry about this migration as much. And obviously, the second kind of limitation, of course, is just that while regulation may actually discourage some bad behavior that we're trying to get banks to cut back on, but it also may discourage desirable activities along with undesirable ones. Obviously, a complaint that I'm sure you all hear a lot today from sort of smaller banks. So kind of one thought is, are there things that we can, so the kind of my bottom line is regulation is imperfect. Personally, for myself, I think that the direction of regulatory reform post-crisis has been laudable, and we've been moving exactly in the right direction. But one wonders whether there's kind of other things that we could do to complement regulation so that we don't have to lean so much on regulation. Or if someone says, I'm still not sure we're there, I'd like to raise capital requirements to 30%, the threat of migration kind of concerns me, and I'm looking for other things that we can do to complement regulation. So an idea that have put forward in some work with my colleagues Robin Greenwood and Jeremy Stein had proposed a kind of a complement to regulation, which we call crowding out. The idea is that the government, so this is sort of a policy the government can use to complement its regulatory efforts, the government should issue more short-term debt than it otherwise would. And the idea is, by issuing short-term debt, the government is sort of providing this exact good that savers in the economy want, this very short-term, safe, liquid money-like stuff. By doing so, the government can depress the kind of equilibrium money-like premium. This is basically the amount of interest that banks save when they issue very short-term, thereby reducing the incentives for intermediaries to engage in excessive maturity transformation in the first place. And relative to regulation, a benefit of crowding out is basically because it works through market-determined prices, it applies to all different types of intermediaries. It applies to regulated banks and shadow banks alike. Of course, just like regulation, this crowding out strategy itself is not a panacea. It has costs. In the case of this crowding out strategy, basically, as we see it, the main drawback is fiscal risk. So, if the government, holding fixed the government debt, what we're essentially proposing is that the government should tilt its debt towards issuing at shorter maturities. If it does so by issuing shorter maturity debt, that's going to make the government's interest bill more volatile. As interest rates rise and down, we're rolling over short-term debt. That will result in a more volatile interest bill than if we issued all 30-year bonds. And big shocks to the interest bill might either force the government to raise taxes or cut back on valuable expenditures. So, fiscal prudence suggests that you typically want to keep taxes as smooth as possible, smooth expenditures, so you wouldn't want to be overly reliant on short-term debt. So this does have a cost. But to the extent that you either think that regulation, to the extent that the less perfect you think regulation is, the more that you'd like to rely on this crowding out. And particularly if you're very worried about migration to shadow banking, using crowding out could be a very useful complement to, say, traditional capital and liquidity regulation. Okay. And in this work, we kind of sketch out how this works in theory. Also provide evidence for kind of the three key premises that underlie this crowding out view. So first is this idea that there's a special demand for short-term money-like assets. Secondly, the demand for these money-like assets appears to be downward sloping. What that means is when the government issues more short-term debt, it reduces this money-like premium. And then third, both short-term debt and short-term government debt and short-term financial debt appear to be substitutes for each other. So exactly as I kind of explained, what that means is when the government issues more short-term debt, it kind of depresses this incentive. In response, financials issue less short-term, more short-term. So there is evidence historically that changes in government debt maturity have kind of had this crowding out effect. And we've also thought some about how to minimize the fiscal risk due to more short-term government debt. This Jackson Hole paper that Ron referenced talked a lot about that, but I'm going to skip that here for today. Okay, so that's kind of a broad picture. Now drilling in a little bit more to shadow banking today. So this is kind of a simple attempt on my part to kind of put together how large the shadow banking system is relative to kind of the total supply of money-like claims. So what I'm doing is I'm looking at all private money-like claims. So these would be things like checking deposits, savings deposits, time deposits, money fund shares, et cetera. Things that we would all think of as sort of being our liquid short-term wealth that are held by the non-financial sector in the US. And then I'm just asking what fraction of those are sort of the very short-term runny stuff that we worry a lot about, either wholesale deposits or money market fund shares. And so what you can see here is, of course, there was sort of a large growth in the shadow banking's market share in terms of kind of providing overall money-like claims leading up to the crisis. And since then, it's massively shrunk down, roughly to the size it was in kind of the mid-90s. So, I'm standing up here talking about migration. Why should we worry about migration to something that already appears to be moribund and it's on its last legs? So I think that depends on why you think it's shrunk so much. Obviously, if you think it's all regulation and we now have the right rules of the road in place, we don't have to worry about the shadow banking system anymore. You're going to be less worried about migration. And I think obviously there have been some good things on that front. So for instance, the Basel III liquidity requirements mean that in some sense, banks' use of wholesale funding is now being taxed. So banks are less desirous of borrowing from money market funds. On the supply side, one of the kind of, basically the gateway drug, if you will, to the shadow banking system, where the most funding from kind of pure shadow banking came from was from what we would call institutional prime money market funds. And until recently, this was still kind of a big kind of lingering thread that had not been completed in the reform package. In 2014, the SEC basically implemented reforms for institutional prime funds, basically telling them that they have to allow their NAV to float and that they have to basically impose fees or gates on redemptions if their liquidity falls low enough. And in response to this, basically what you've seen is there's been a massive flow out of these institutional prime funds and into government money market funds. So part of it could be regulation, and we've sort of have killed the shadow banking system. Another reason why it's shrunk so much is obviously just investor beliefs. Investors thought that this was another safe way to kind of make money-like claims. The crisis suggested maybe that wasn't so, but what will happen is sort of memories fade. And then the third point that I'd like to suggest is, so I certainly think regulation has played a role, but I'm a little less I'm a little less certain going forward that the shadow banking system will remain as small as it is, in part because I believe that today's low interest rate environment is actually a big part of why the shadow banking system is not as large. So specifically, and this is why I'm kind of more worried about migration back to the shadow banking system going forward, if and when short-term interest rates ever rise again. So in the past, deposits have tended to flow out of the regulating banking sector. Basically, banks lose core deposits, and they flow into either money market funds or into kind of large time deposits when short-term rates are either high or rising. And here's kind of a simple illustration of this. Basically, you can regress, what's the fraction of all money-like claims that are kind of being provided through this that are runny in nature from the shadow banking system, and it tends to rise strongly both when rates are going up or rates are high. And this is a plot of the actual year-over-year change in this versus the fitted one from this simple regression. So why is that the case? Well, actually, a couple of Viral's colleagues at NYU have an excellent recent paper on this. What they show is that as interest rates rise, traditional regulated banks basically exercise market power over less sophisticated savers. And what that means is that deposit rates that are paid on savings and small time deposits basically tend to lag well behind the federal funds rate. So the solid black line here is the federal funds rate. The dashed green line is interest checking. The dashed red line is savings deposits. What you can see is those increases in kind of wholesale interest rates are barely passed through at all to kind of the rates that we receive on deposit products. So what that means is that as interest rates rise, what happens is, the less sophisticated savers tend to kind of stay stuck in the banking, tend to stay stuck with regulated banks. But you see institutional savers and more sophisticated savers basically pulling their money out and putting it into either large time deposits or into money market funds. To the extent that all this is doing is just changing the way that regulated banks are being financed, if it's simply just they have money flowing out of their savings deposits and flowing into large time deposits, then in cycles past this would have posed a problem. But today this is probably being somewhat covered or taxed by the fact that we do have the LCR and the NFSR in place. However, historically, a big chunk of this has gone into kind of funding the pure shadow banking system. So what I would be concerned about is, as money starts to flow out of the system, what we're going to see is that institutional savers will revert to prime money market funds, who will then kind of be flush with cash that they need to invest, and will be looking for sort of shadow bank-like paper to invest that in again. Thing that, a useful antidote that the government can take is if the Treasury were to say expand the supply of Treasury bills, that would actually tend to reduce the incentive for funds to say flow out of government funds and into these prime funds. So again, this kind of crowding out strategy could help to reduce this migration threat. So in conclusion, I think going forward, I do, while I think the shadow banking system is obviously way less of a threat than it would have been in 2005, I do still worry about possibility for risk to migrate back towards shadow banking. And has suggested that a larger supply of short-term government debt should be lower. More generally, I think, so I've talked specifically about kind of shadow banking. More generally, I think that obviously there is a risk for heightened regulation of traditional banks to induce migration of other different types of credit activity to non-banks. So for an example that I've been made aware of is apparently over the last decade or so, many of the largest banks have kind of exited small business lending in spades. Anecdotally, based on conversations I've had, this is often because they perceive that it's an increasingly poor return on capital, given heightened capital standards which are associated with the CCAR. And increasingly, kind of small business lending is being taken up by alternative non-bank lenders, things like on-debt capital, who really aren't subject to prudential capital regulation of any sort. So, one would still, they're not offering deposits, but one would still worry what would happen to the flow of small business credit if these alternative lenders were hit by a common shock and were then slow to recapitalize. So it's kind of thoughts like this. While I broadly support post-crisis regulatory reforms, it's thoughts like this that kind of give me pause when thinking about say raising bank capital requirements to 20 or 30%. So thank you. You want to?
Okay, well, it's great to be here. I want to thank the organizers for including me. It's especially nice to share the stage with Viral and Sam. Viral's been a leading thinker in this area for many years. As for Sam, he and I served together in the Geithner Treasury Department in the dark days of early 2009, so he and I have been speaking about this stuff for quite some time. So the topic is shadow banking. My remarks will focus mostly on short-term wholesale funding. People define shadow banking in different ways, but pretty much everyone agrees that short-term wholesale funding is a big part of it. And in particular, I'm going to talk about entry restriction into bank money creation. This topic, I believe, has received insufficient attention in the financial reform debates of recent years, and I'll suggest that a modernized approach to entry restriction could hold promise for both strengthening and simplifying modern financial stability regulation. In fact, I'll argue this approach could help us make substantial headway in addressing the too big to fail problem. So the first thing to say about entry restriction is that it's been a core part of banking law for a long time. I'm going to review some history here. Don't worry, I'm not going to read all the text here, but we can start in England in 1708. I'm just going to give you a few examples. So this was the decade following the creation of the Bank of England. Some other firms had started to get into banknote issuance, and Parliament put a stop to it. And what it says, again, I won't read the whole thing. It says, it shall not be lawful for anyone other than the Bank of England to use short-term debt funding. And it specifies a maturity cutoff of 6 months. There's some other details on here. There's an exemption for small partnerships. Courts quite sensibly interpreted this not to apply to trade payables of commercial firms. And this took some twists and turns in the 19th century, which we don't need to get into. What I want to emphasize is the structure of this law. Note that it is a generalized prohibition applicable not to the Bank of England, but to everyone else. It's a prohibition on a particular liability structure. And it amounts to a structural barrier to the creation of monetary instruments. Okay, another example, so moving to the New World, fractional reserve banking arose on a meaningful scale in the US in the 1790s, and soon thereafter states passed entry restriction laws. This is an example from New York State in 1804, and what it's in, again, other states had similar laws. What it says is, it shall not be lawful for any person, association, etc., to have deposit liabilities or to issue banknotes without a banking charter. So these laws also took some twists and turns. A number of states liberalized entry into banking in the 1830s. There's an ongoing debate about the success of that experiment. But what interests us here again is the basic structure of this law. It's a generalized prohibition applicable not to chartered banks but to everyone else. It's a prohibition on a particular liability structure. A banking charter confers an exemption from the prohibition, and it amounts to a structural barrier to the creation of monetary instruments. All right, moving to the federal level, you'll see a pattern here. Congress, of course, passed the National Bank Acts in 1863 and 64, creating a system of federally chartered banks. In so doing, Congress sought to federalize money creation. This time it did it through taxation, but it's still the same basic idea. What it says is every person, firm, etc., shall pay a tax of 10% on the amount of their notes used for circulation. So again, this is a generalized prohibition. It's a tax this time, but it's a prohibitive tax. Applicable not to national banks, but to everyone else. It's a prohibition on a particular liability structure. A national bank charter confers an exemption from the prohibition, and it amounts to a structural barrier to the creation of monetary instruments. This ended up being only partially successful, famously because state banks shifted from banknote liabilities to checkable deposit liabilities. All right, this is the last one today. So we still do entry restriction, of course. This is 12 U.S.C. 378A2. It is the single most important law in provision in all of U.S. banking law. It's been in basically this form since 1933. And in essence, it says, again, I won't read it, to paraphrase, thou shalt not maintain deposit liabilities without a banking charter. So it's the same structure. It's a generalized prohibition applicable not to banks but to everyone else. It's a prohibition on a particular liability structure. A banking charter confers an exemption, and it amounts to a structural barrier to the creation of monetary instruments. So the effect of these laws is to confine money creation to the government itself and to one or more specially chartered banks. And the question I want to ask is whether a modernized approach to entry restriction might have a useful role to play in modern financial stability regulation. There are obvious downsides to entry restriction. These laws are inherently anti-competitive. They confer market power on chartered banks, but it doesn't follow that entry restriction can serve no legitimate policy purpose in the area of money creation. And just to tick through some plausible policy justifications. So to the extent that this funding model is unstable, entry restriction can facilitate the regulation and supervision of this activity. It can enhance monetary control and improve the efficacy of monetary policy. And finally, insofar as money creation is associated with a revenue stream or seigniorage, entry restriction can put boundaries around this form of revenue. This relates to what Gary Gorton and others have called charter value of banks. So now, if you want to restrict entry into money creation, you have to face a really basic threshold question, which is what precisely do you want to prohibit? Specifically, you have to define the liability structure that's off limits as a legal matter. We saw above that under current U.S. law, you can't have deposit liabilities without a bank charter. But what is a deposit? It's worth looking at that definition. And again, I won't read the whole thing. The term deposit means the unpaid balance of money or its equivalent received or held by a bank. And I'll stop there. This is already off to a really bad start. A deposit is a liability, so it's not obvious why the legal definition of deposit should depend in any way on what the bank received. If a bank makes a loan by crediting a deposit account in exchange for a promissory note, presumably that's still a deposit, even though the bank hasn't received money or its equivalent. But for our purposes, what's more important is the words that follow, which is, again, a deposit is unpaid balance of money or its equivalent received or held by a bank for which the bank, has given credit to an account. So we saw a minute ago that under U.S. federal law, only chartered banks can have deposit liabilities. Now we see a deposit is defined as a liability of a bank. So we're in a perfect legal circle. And unsurprisingly, this leads to weird results. So when the money fund industry arose in the late 70s, the SEC was faced with the question whether claims on money funds were deposits. The SEC asked the Department of Justice for a legal opinion, and the DOJ wrote back in a masterpiece of legal formalism, no, claims on money funds are not deposits because they are equity and not debt. So the DOJ ignored economic substance. It ignored the fact that money funds arose, of course, precisely to create deposit substitutes. But it's easy to be critical. The real problem here isn't with the opinion, it's the underlying statute. It didn't give them much to work with. All right, so some may be thinking, why go through this legal minutia? Surely we have bigger problems. Shouldn't we be talking about shadow banking? But it's not obvious to me that we do have bigger problems, and I am talking about shadow banking. So this brings us to the institutional reality of money today. It's a truism of finance that banks create money. Used to be, now it's transaction deposits. It used to be banknotes. But there's growing recognition, and I think this was evident in Sam's presentation also, that in a very real sense, the shadow banking system creates money too. These short-term liabilities of shadow banks are deposit substitutes. They serve a distinctly monetary function in a way that longer-term securities, no matter how safe and no matter how liquid, don't seem to serve. So I could say a lot more about this, but I won't. I'll just say there's a reason why short-term debt, high-quality short-term debt is classifiable as cash equivalent for accounting purposes, whereas longer-term securities must be classified as investment securities, again, no matter how safe or how liquid. And the accountants use a maturity cutoff of 3 months for this purpose. Similarly, there's a reason why terms like near money and money market have long been applied to the short-term, high-quality debt markets, but not to longer-term securities markets. Again, even AAA long-term securities markets. So I said there's a growing recognition of this monetary dimension of short-term wholesale funding, but it's clearly not a new concept. So here's Henry Simons, a founder of the Chicago School of Economics in 1934, saying short-term debts are closely akin to money. Keynes, in the general theory, in his discussion of liquidity preference and distinguishing between money and bonds, suggested a 3-month maturity cutoff. I find it kind of fascinating that he ended up with the same maturity cutoff that FASB and the modern accountants do. John Hicks, in Value and Capital, short-term debt instruments are very close substitutes for money and have a moneyness property. Friedman and Schwartz also use that term moneyness. Sam and Jeremy and Robin have used that term moneyness in their work. Gary Gorton uses terms like private money and moneyness. Again, this recognition, while far from universal, I've discovered, is pretty widespread. But if we take this seriously, it forces us to face the question whether there is an intellectually respectable basis for the stark legal dichotomy between deposits on the one hand and non-deposit cash equivalents on the other hand. And just to be concrete, this is a different version of something Sam did in his presentation. Here's a picture of what I call money claims outstanding. This goes from 95 to 2013. These are dollar-denominated short-term or demandable debt instruments, payable in cash or its equivalent, excluding trade credit. I'm using a 1-year maturity cutoff here, although these are heavily concentrated at the very, very short end of that range. And this figure's on a gross basis, so I'm just counting contracts. And I divide it between sovereign and private. So sovereign are the darker shaded ones at the bottom, private are the lighter shaded ones at the top. And so sovereign consists of, going from the bottom up, currency and Fed balances. So those two bottom lines are the right side of the Fed's balance sheet. Then we have insured deposits and treasury bills. So these are all sovereign because the government is either the issuer or the explicit guarantor. And then we have the private categories, and most of these will be familiar to this audience. But again, from the bottom up, you have repo, you have the various types of commercial paper, asset-backed financial, and non-financial. I include non-financial CP here, even though it's a trivially small market. It's barely even visible in the figure. I have SEC lending, collateral IOUs. I have euro dollars, which is dollar-denominated short-term debt of non-U.S. financial institutions. It's actually the single largest category for most of this period. I have uninsured deposits, and then I have money market fund shares at the top. So this is the institutional reality of money today. If you look at the cash and equivalents line on the asset side of any institution, it consists of some combination of the instruments in this figure. There are a couple others that are missing for which we don't have data, but these are all the big ones. So essentially, we've allowed a parallel system of money creation to arise outside of our system of sovereign control. And these markets here's the private ones alone, which shows the contraction with the crisis. This looks more like Sam's figure here. The other thing I didn't point out about the previous figure is the size of the market. Right, on a gross basis, it's $25 trillion of claims. So we're talking about a very, very sizable market. This is the private alone, which shows the massive contraction with the shadow banking panic in 2007 and 8. This is the private. This is similar to Sam's chart. This is private money claims as the private share of total money claims. And so we get up to a peak of 75% of the functional money supply counted on a gross basis, again, being private claims as opposed to sovereign. And of course, that has contracted dramatically in the aftermath of the crisis. So these markets are dangerous. Again, this is pretty widely, although not universally, recognized. Here's Walter Bagehot in 1837. Of the many millions in Lombard Street, infinitely the greater proportion is held on short notice or on demand. If these markets unraveled, it would endanger the industrial system. Here's Henry Simons again. He was amazingly prescient on the shadow banking problem. Henry Simons wrote in 1936, the economy becomes exposed to catastrophic disturbances as soon as short-term borrowing develops on a large scale. There's a pretty strong case that these markets pose a uniquely grave threat to the broader economy. On my reading of the evidence, other types of financial disruption are not nearly as damaging as panics in the money market or in panics in monetary instruments. This relates to, Gary Gorton has pointed out that with the advent of federal deposit insurance in 1933, the U.S. entered an unprecedented 75-year quiet period with no banking panics. This was also a period of remarkable growth and prosperity in the U.S. economy. There were no economic disasters on the scale of the Great Depression or Great Recession. And notably, the private runnable money markets were quite small during the quiet period. We didn't start to see explosive growth in these markets until the early to mid-1990s. So it wasn't until the large-scale emergence of shadow banking, defined as private money creation outside the chartered banking system, that instability returned. This historical experience offers some reason to think that this problem is not completely unsolvable. So in a book, Ron referred to a recent book that I wrote, published by University of Chicago Press, in which I treat these issues in greater detail. The core message of the book is actually quite old-fashioned. I make the case that financial instability is largely a problem of private sector money creation, and really it always has been. I say this is old-fashioned because this does not seem to be the prevailing view among experts today, and it pretty clearly is not the view underlying financial reforms of recent years in the U.S. or abroad. Now, Neil Kashkari has talked about the need for transformational reform of the financial system. So it seems to me that one of the things that should be on the table is a modernization of the traditional centuries-old structural tool we've been looking at, which is entry restriction into money creation. And how would this work in practice? So the basic idea would be to say you can't use this funding model, which consists of lots of short-term or demandable debt, continuously rolled over, unless you have a banking charter. The use of this funding model would be the privilege that a banking charter conveys. Notice this isn't a fine-tuning approach. We're not calculating a ratio or estimating risk exposures. This is a different type of animal. It's a structural firewall. And of course, you would need to think about how to specify the contours. You would need to think about refinements and exceptions. You would definitely want to exempt trade payables from any such prohibition. You might want to exempt non-financial commercial paper, although, as I mentioned earlier, that's a trivially small market. You would need to think about derivatives and securities lending and how to prevent evasion. You would need to think about international dimensions, but these are all standard types of regulatory problems. The key point would be to reach a functional legal specification of what constitutes a monetary instrument, and then to confine the issuance of those instruments to the charter banking system. This would mean big changes for the financial sector's funding model. It would be transformational in this respect, but this only goes to show how far money creation, broad money creation, has bypassed our system of sovereign control. All right, what are the advantages of such a system? They're the same advantages I referred to earlier. It's conducive to stability. We would establish a clear regulatory perimeter around this activity, which would facilitate regulation and supervision. It would enhance monetary control and improve the efficacy of monetary policy, and it would limit the leakage of seigniorage revenue. And let me mention two more advantages. The first relates to too big to fail. So it's well understood, and this relates also to our first panel this morning. It's well understood that short-term wholesale funding makes the insolvency and resolution of large, complex financial institutions a lot more complicated. This is reflected, for example, in the TLAC standards, total loss absorbing capacity standards, which prohibit large financial institutions from having runnable funding at the holdco level. I say runnable. Sam said runny, which I had never heard before. I like runny. I like my eggs runny and my debt not runny. If this is so, TLAC prohibits large financial institutions from having runnable funding at the holdco level. If this is right, then entry restriction should be expected to enhance the resolvability of non-bank entities. This could allow for a reduction in implicit public backstops and associated funding subsidies. So in this way, entry restriction could help ameliorate the too big to fail problem. More generally, the approach I'm describing could pave the way for a substantial reduction in the scope and complexity of modern financial stability regulation. By doing this one thing reasonably well, we could arguably stop trying to do a bunch of other things. And I'll conclude with just anticipating your objections, of which I know there are many. The first is regulatory arbitrage. Won't the financial sector just sidestep the restriction? My answer is, of course, this is an issue, but it's a problem for pretty much every regulatory system. I see no reason to think it has any special application here. One way of thinking about this is when financial market participants start lobbying the accounting authorities to classify any given class of instruments as cash equivalents, then that's a red flag. That's what happened with auction rates and variable rate demand notes in the mid-2000s. The second objection is moral hazard. By confining money claim issuance to chartered banks. Aren't we increasing government backstops? I would say the opposite. This is a containment strategy for moral hazard. As the recent crisis demonstrated, we probably are standing behind these markets no matter what. The third objection is costliness. So won't this increase costs of capital and suppress economic growth? I think the quiet period goes a long way toward alleviating this concern. Remember, that was a period of, on balance, pretty great growth and prosperity, and we just didn't have a large runnable money market during that period. It was pretty small. The vast bulk of the money supply consisted of insured deposits. So that does alleviate this concern to some degree. Also, we need to compare costs against benefits, and the costs of panics in money claim markets appear to be astronomical. Fourth, are panics really the main problem? I think there's a pretty strong case that they are, at least to the extent we're concerned with preventing macroeconomic disasters. As I mentioned earlier, other forms of financial disruption don't seem to be as damaging. There's an irony here. This is the most primitive part of the financial system. This is zero coupon IOUs, right? It's the first thing you learn how to value when you start to learn finance. We're not talking about the outer reaches of modern finance. We're talking about the most primitive part of it. Finally, this is my last bullet, and I'll conclude here. Are there other less invasive alternatives apart from entry restriction? And I'm not going to answer that. We can maybe leave it to Q&A where we can talk about maybe crowding out and some other possibilities. I'll stop there.
Great. Thank you, Neil, and thank you, Ron, for inviting me to speak. I don't have slides, but I have some notes. I'm going to speak on the basis of that. So I wanted to think about shadow banking a little bit more broadly than the first two sets of speakers have. And I think it's sort of maybe a natural segue into what I want to talk about. I should just mention at the outset that much of what I say now is based on some joint work with Guillaume Plantin that we are still trying to complete. It's called Monetary Easing and Financial Instability. And this project is really something that's, we're trying to build a sort of a new Keynesian monetary policy model in which there's a penalty function for financial fragility. I think that's what we are really trying to do, which is that right now we always have these discussions that monetary policy and macroprudential are like two separate tools. We should keep them separate. And we want to offer a way in which there might be a way to integrate them. It turns out when you do this, much of it, you have to start worrying about shadow banking and things like that. So that's how it connects to the topic for today. So when I talk about shadow banking, I'm going to focus on what I'm going to call as excess maturity transformation. And by excess, I mean it's not in the interest of the economy. Some of this could be happening on regulated balance sheets as well. But the whole idea of regulating them is to actually contain the extent of maturity transformation they're doing in the first place. So when I talk about excess, very often it's going to end up in the unregulated balance sheets as well. Of course, if your regulation is not very good, then much of the excess could be happening on the regulated balance sheets as well. And I think one way that we have historically thought about this risk of excess maturity transformation, I think Sam put it very nicely, is more in the context of microprudential regulation, that we seem to be subsidizing short-term debt in one way or the other. It could be that savers are subsidizing short-term debt because they have a preference for money. Or it could be that the governments / central banks are subsidizing short-term debt because when short-term debt panics happen, we have no other way of dealing with them but to actually backstop them either through a lender of last resort or through full-scale bailouts of the entities taking on short-term debt. So in this view of inefficient maturity transformation, it's all about leverage. It's all about the fact that we are subsidizing leverage at the short maturities in one way or the other in the economy. Either it's an investor preference and then there are some externalities with the runs, or the externalities don't really materialize because we backstop them, but then there's a moral hazard problem that arises from that. But I want to switch focus onto one other kind of distortion that I think has become quite prevalent over the last 20 to 30 years especially. And I'm going to call that as an interest rate subsidy for maturity transformation. I could have chosen the term search for yield, but I'm going to come back to why I don't exactly call it search for yield. My sense is investors are always searching for yield. They're always looking for more yield. And I think that's the reason why I don't want to call it search for yield. So the idea of calling it an interest rate subsidy is going to be the following, which is that what monetary policy tries to do when it, say, chooses lower rates or eases, whatever is our favorite term for that, is that they basically want to manipulate, and I'm going to use the word manipulate, they want to distort the short-term interest rate in the economy, at least for a short while. Increasingly, we are sort of comfortable doing it over even extended periods of time. But I think even if you take it for a short while, the idea is that what that creates is a distortion in the market for short-term borrowing in the following sense, which is that let us say that certain high-yield assets were not profitable for me because if I funded them with equity or if I funded them with, say, at the natural rate of interest in the economy. Why? Maybe these higher yield assets have greater risk, maybe they are very illiquid, and I don't think I'm being compensated enough for the risks that I undertake. But lo and behold, someone comes and distorts the short-term rates of borrowing in the economy. How do they do that? There's an open market operation that's actually manipulating the rates, the natural rate of interest in the economy. And now all of a sudden it looks like, let me raise the short-term borrowing at this subsidized cost. I'm going to call that an interest rate subsidy for short-term borrowers in the economy. And I'm going to take on the rollover risk in the process. I'm going to take the risk that I'm going to have to keep rolling over this paper in the market. But because I'm getting this subsidy over a short period, potentially long, but at least for a short period, suddenly some of the assets I had been searching for, but not been finding them profitable to invest in at my natural cost of capital, now they actually look attractive for me to fund with this. I'm going to call this a carry trade. Instead of searching for yield, because I think the important thing about this is that it actually generates profits for the financial arbitrageurs or these maturity transformers as carries. They are basically getting some yield on these long-term assets. For a short while, they're going to be able to fund these as short-term at short-term costs of borrowing. I'm assuming that they can pocket this carry, they can pocket these premia, pay themselves out these carries. And that brings me to the point of shadow banking, which is that if you were regulating this, you would say, no, you can't take this carry and pay yourself out. You have to actually keep it as a reserve, either as a margin or as you build your equity reserve into the holdings of illiquid long maturity assets that you have. But if you don't face such restrictions, or the illiquidity risk is not being adequately reflected in your margin/capital requirements, then the carry trade becomes profitable. So, in some ways, I think so. The reason why I'm focusing on this as a separate kind of subsidy is because I think the leverage subsidy, we have focused a lot on what I would call as the solvency risk of the balance sheets. You give a preference for leverage. That means whatever assets you are undertaking, you're going to fund it with more leverage rather than equity, and that's going to lead to some sort of solvency risk, even if the leverage was actually at a slightly longer maturity. I'm going to say that the interest rate subsidy is basically a subsidy for illiquidity risk. It could potentially also be funding riskier assets, but essentially it facilitates rollover risk of various types that wouldn't have otherwise made sense for financial investors in the economy. So why is this channel for shadow banking that arises with easy monetary policy interesting? One, because there seems to be evidence that suggests that shadow banking historically has grown in size when interest rates have been low during periods of expansionary monetary policy. I have to square that evidence of IMF's Global Financial Stability Report with the evidence that Sam suggested, where at least between banks and money market funds, perhaps the substitution is going the other way. I think it's interesting because we seem to be in extraordinary times in the sense that while at least the US might be soon exiting the low interest rate environment, there are many parts of developed economies which are delving even deeper into exploring this territory. Third reason why I think it's interesting is because I think that the shadow banking risk that gets created with this interest rate subsidy, it's a risk that arises when the intermediaries actually recognize that they are taking on rollover risk. So it's just that you are artificially cheapening their cost of capital for funding this illiquid asset. You're giving them low short-term interest rates, allowing them to punt on the interest rate in the rollover markets. So they internalize the full risk, and yet actually this is beneficial for them to undertake. So Jeremy Stein, before the taper tantrum speech, had a very nice speech when he was a governor at the Board of Governors. He spoke about the fact that he called it the search for yield. There's been a lot of that going into the high yield and the junk debt during the QE phase of the Federal Reserve's interest rate policy, covenant-light leverage loans. And on the other hand, what's that doing? The supply of short-term debt into these sorts of assets. It's corporations are basically issuing bonds to soak up the money that's flowing into the bond mutual funds being sold with redemption rights, and they are buying back shares with it. You could make a same story on housing, mortgages, mortgage-backed securities. I think these were the carry trades that were going on in good times prior to the 06-07 crash. And of course, that could now feed into a housing boom and bust cycle. I think there's a lot of evidence from Bank for International Settlements that suggests that emerging market bonds, both through governments as well as corporates, every time there is a new wave of QE or ultra-low policy being adopted in some part of developed economies, it basically creates a beginning of a new leverage cycle by the emerging market corporates and governments. Because emerging market bond funds now get inflows because the rollover risk associated with these bonds is now worth it at the dollar or the euro or the Japanese yen cost of rolling over these debts. And in the extreme case, if fixed income markets are very underdeveloped, the country has some capital restrictions, then you get something like China in 2014 and 15, where you're trying to deal with a banking problem with ultra-low interest rates. So where do the savers go and put their money? They start funding margin lending into the stock market. You get a 200% price run-up in 6 months, and then a complete contraction once they realize the stock market is on steroids. I think all of these manifestations are somewhat interesting because I think they bring even things like the asset management industry, insurance companies, into the framework of what I would call more broadly as financial instability. Now, I don't want to use the word systemic risk because I don't think systemic risk is the only thing that I think financial regulators should be concerned about. I'll come back to this point a little bit later. Of course, some of the shadow banking entities may not look exactly like banks. Maybe their runnability problems are not as severe as those associated with banks. But I would argue that if you create this distorted financial gains from rolling over short-term paper on illiquid assets, it's going to actually increase the cost of capital for real investments in the economy, because the financial capital that should actually be used by corporations or financial intermediaries to channel funds into the real assets, it's now competing on returns that are being generated with a purely financial arbitrage technology on the side. So these two, of course, have to work in equilibrium. So to summarize, instead of leverage, it's maturity transformation that's being subsidized, in my opinion, through a low interest rate policy environment. And now we have to think about what are the costs associated with this. So So in our paper, we talk about this recent piece that's been put out by Jason Furman from the Council of Economic Advisors, where he talks about a variety of interesting phenomena that we haven't seen existing together for a while, but we are seeing them in this low interest rate phase since 07-08. So huge bond and other fixed income security issuances. At the same time, high shareholder returns. Returns to shareholders over the last 8 years have been fantastic. At the same time, if you look at fixed real investment in the economy, it's been extremely low by historical standards. Marginal product of capital is actually very high, again by historical standards, which almost seems like a conundrum, which is that you have marginal products of capital being very high, but the returns, the investment into fixed real investments are actually very low. And I would argue through some examples that there has been rollover risk of certain types during this phase, not the bank runs that we saw in 07-08, but of some other types. Now, how does all this square up with what I said before? Why the issuance of bond and other fixed income securities? Because those are being held by bond funds, and the bond funds are basically being sold with redemption rights. So at some level, it's not exactly debt, but there are rights of redemption that are being associated with these flows that are going in. So investors are searching for yield. They could go into deposits, but they are saying, no, I want to go and buy an emerging market bond because now it's cheap for me to take the risk of withdrawing from this emerging market bond if the risk materializes or this asset becomes illiquid. Why the high shareholder returns? Because the carries that are being generated are just getting paid back. So for example, think of corporations that are doing big issuances of junk debt or even other kinds of debt. They are not using it for real investment, as I just said. It doesn't add up when you look at the size of bond issuances with the size of investment in the economy. They are being used to do shareholder buybacks. So there's very high shareholder return. So all that corporations have been doing is creating shareholder wealth by rebalancing the right-hand side of their balance sheet rather than actually generating returns to shareholders by doing more investment on the left-hand side of their balance sheet. And so the marginal product of investment remains high. Now, why does that remain high? Because you won't find a real investment profitable unless it generates the kind of return that you can generate for your shareholders with just a shareholder buyback that's funded by issuing corporate debt. Because you have a crowding out problem, which is the marginal dollar that the CEO is investing in a real investment versus just doing a buyback has to now square off these two returns for him to be generating shareholder value, which is sort of his mandate. So when I give this story, sometimes people are concerned that really we haven't seen any significant rollover risk in the US over this low interest rate period. I would actually beg to differ from someone who's from an emerging market and was actually in India during the taper tantrum of the post-May 2013 phase. So if you look at the evidence that the IMF has collected, prior to 2007-2008, 50% of capital flows were sort of balanced between, 80% of the flows were into developed economies and 20% of the global flows were about emerging markets. Since 2007-2008, this has become 50-50. The higher yielding, the higher interest rate economies have been actually receiving massive inflows and in some cases outflows when the interest rates in developed economies have been raised or signs that they are being raised have been offered. So once the taper was announced on 22nd May, it was called the taper tantrum because primarily it led to huge withdrawals from a large number of emerging markets that over the next 2 to 3 months, especially in June of 2013, essentially witnessed 3 to 6 sigma capital outflows compared to what they were used to seeing on a monthly basis. There were 15 to 30% currency revaluations for all these markets. And I think it's a very interesting episode because the effects of the maturity transformation that took place, in my opinion, they all manifested outside of the US economy. So it's something that the Federal Reserve may or may not be directly internalizing. Maybe the spillover effects are not that direct, or at least they're not that easy to model. If you have an emerging market slowdown on growth, how is that going to come and feed back into the US economy? And you don't even see that because they are not going to sit quiet. They are going to actually respond with their own monetary policies, lower rates at their end, which in turn might create some other kinds of pressures on your own monetary policy, and so on. Now, in the period, I think the other reason why I think this episode happened with emerging markets and not the way it happened, say, in 90s during the Alan Greenspan era, and there was a very famous Forbes article in 95 called The Bloodbath, when Alan Greenspan announced the interest rate rise and insurance companies were losing market valuations left, right, and center because they'd all done maturity trades. But all of those were maturity trades between short-end and long-end government bonds. But what we did with QE is that we actually brought the long end of the government bond very down as well. So the search for yield now really had to happen somewhere else rather than actually in the long-end treasuries. So in any case, my sense is there has been a very violent episode of this rollover risk manifesting. The costs were, I think, borne by other economies. I'm not saying their corporations and their governments who borrowed at the low costs were not at fault. I think they could have managed their balance sheets a little bit better. But I think when a market rate is distorted for an extended period for a long time, it's easy for them to also want to do carry trades because I think they are now punting that. So all emerging market corporations, for example, who borrowed in the dollar markets are basically punting that when we can't roll over, our central banks are going to now lower rates and effectively bail us all out. So I think it's a bad equilibrium in interest rate policy between different central banks. So let me come to what are the implications of this for regulators. I think one implication, as I said, is that while not a very traditional way of thinking about shadow banking, I think it creates this potential that a distorted price of short-term funding in the markets may actually be creating a shift into where money is going. It could go away from banks into non-bank finance, let's call them shadow banks, including asset managers, simply because banks are being regulated at the same time tight, the others are not, and you could see new kinds of illiquid assets being funded because the rollover risk is now cheap to take on. So what should regulators do? I think my sense is that perhaps this is the penalty function for adopting ultra-low rates for a very long time, in my view. The traditional theory for adopting the ultra-low rates, if you took some new Keynesian model, would say, I'm basically trying to stimulate aggregate demand or aggregate production because there's some preference shocks or price rigidities that I'm trying to fix by keeping interest rates low. So because something else is rigged in the economy, there's some temporary preference shocks that prices are not able to reflect. Let me rig another price, which is the price for short-term debt, and then I'll ensure that these two offset each other and I can get demand, production, etc. to be at the right level. But I think every time you rig this one financial rate, what happens is it creates all these rollover risks. And when they manifest, that's a penalty function that now the central bank should take into account. Now, the penalty is of two types, and I think that's what I want to stress. One is a pure financial instability cost, which is that when the rollover manifests, there might be costs associated with that. Now, as I said, there were fire sales of emerging market bonds and emerging market currencies. Now, in this particular episodes, perhaps the costs were not directly borne by the central banks whose low interest rates had fueled these carry trades. But there's the other cost, which I think may be potentially more interesting and important, which is that because there are such high returns to just rollover risk in the financial sector, that becomes their funding engine, that becomes their profit engine, rather than actually looking and searching for real investments to actually put the money to good use. So there's a crowding out that's going on in the background, which would explain why, along with this high returns in a financial sense, you have a coincidence of high marginal product of capital and low real investments, which of course go hand in hand. Now, there is also another implication of this. So the implication of this is basically that once you have this penalty function, you probably would not go too low in your interest rate policy when you ease, because beyond a point, you actually are crowding out real investment. And in the model formally, that's sort of the point at which you stop. There's a second implication here, which is that, of course, you could fix this by saying when the rollover risk manifests, I'm going to actually not provide any liquidity support to the market. So you could favor more liquid assets in your lender of last resort, create bigger haircuts for lending against the very liquid assets, and you could create a preference for investments in more liquid assets or safer assets when you do this. Usually these things are not very time consistent. It's just not credible that if there has been a huge distortion over a 5-year period of moving into an asset class, when that's unfolding, we will not actually provide easy liquidity back at that point. But basically this says that now these two can't both be going on at the same time, which is you can either support the rollover risk from not manifesting as fire sales ex post, but that is going to subsidize the shadow banking sector even further, and the only way out is to then actually quote unquote kill it in good times by keeping interest rates high. You just can't subsidize their short-term borrowing. Or you can subsidize in good times because you want some stimulative demand effect, but now then you have to have a credible policy to impose huge costs on shadow banking and let them just unwind, which may or may not be possible. So let me come to a few concluding remarks. How does all this relate to the other popular view of shadow banking, which is that it's really about regulatory arbitrage of the macroprudential regulations we are trying to implement on the commercial banks and other regulated entities? I think it's consistent with that view, but it's somewhat complementary in the sense that even without a pure demand for money kind of assets, a distorted short-term interest rate by the central bank can create a preference for these sorts of maturity transformation. And then, of course, it's going to happen on those balance sheets where it's not being regulated. And so it's a combination of low interest rates and regulatory arbitrage of wherever you are allowing maturity transformation to take place where this is going to manifest. But sometimes, as I said, you may not even be regulating it well on the bank balance sheets, and then you could have perverse unintended consequences even on the regulated balance sheets. For example, in Italy, what you find is that since the expansionary policies of ECB in 2012, because the Italian banks were allowed to remain very undercapitalized, and I think at least on Italian banks now there is no confusion whether it's book values or market values. I think they are just undercapitalized, whichever way you look at them. They basically took the cheap money and they've just been doing zombie lending the way Japanese banks did in 2000 in the 90s. So of course you could have just other unintended consequences not happening in your shadow banking because you're allowing bad maturity transformation to just take place on regulated balance sheets. Let me conclude. So I think that we need to think about a penalty function to ultra low monetary policy, which comes from this maturity transformation. If you have some macroprudential apparatus in the background, it's going to happen in the non-bank finance, in shadow banking. There are things I didn't talk about or just briefly touched upon. I do think that this contributes to a race to the bottom in interest rate policies of central banks. I think emerging market central banks have been reacting every single time some low interest rate policy has been adopted in the developed world. That makes the exit very hard because their policies are having an impact on your exchange rate as well. So I think that difficulty has to be borne in mind. So even if the maturity transformation asset is outside of your economy, it could be that it's going to come back and hit you in one way or the other because of this race to the bottom in interest rates between central banks. And I think it also raises this issue, which is that our mandates for central banks are right now very national. Of course, in the end, national mandate should be the one and it should be fine. But increasingly in today's world, I think we may have to think much harder about how international capital flows and policy spillovers may then be feeding back into what are the second round and third round effects. If central banks of emerging markets had not responded after the taper tantrum, what would have been the implications for the global growth? Would they have been significant for the US economy? That's the question.
Great. Thank you. See if there's any questions from the audience. Yep, right here in front.
Yeah, First of all, really like to thank all the panel. It was really great, very illuminating comments from all of you. Thanks, it was very useful. So I was thinking about what Sam and Viral said. They had some common theme, and the theme is we keep an interest rate too high. I mean, you had the things of this very negative premium, and you say one thing we could do is a fiscal thing, which could be also a monetary thing. You know, we should keep the low interest rate a little bit higher. And you also have the same thing. So I thought that was interesting. So, and of course, it's an issue that once you enter the low interest rate cycle, it's very hard to exit. But that's you should think more entering the cycle. You should not go there. And so that's and the other thing is the question for Viola is that so you highlighted very clearly this kind of leverage of cycle. You enter, you borrow short term, and you invest in these long-term assets, and that's a negative consequence because it reduces the productive investment. But in some sense, how can we measure that? There should be some indicator that we can see as a Federal Reserve say, that's too much of that. And you know, there's some measure of leverage of clearly very high before the financial crisis, but now, as far as I know, there's not much of that. So, do you have any idea what kind of indicators should be looking at to see whether we're going to be in this kind of trouble?
Yeah. So I think on the second question, so I think in Jeremy Stein's speech, he talks about a few indicators that he was trying to document, including actually some joint work with Sam, where he talks about big flows into new asset classes. So, you know, like sudden shifts of flows into junk bonds, covenant-light leverage loans. You might see some of these also in the compressed premia that arise because so much money is actually chasing. So, of course, the emerging market currencies that depreciated 25 to 30%, of course, they had significant run-ups prior to this when they were actually being chosen as the preferred asset for these flows. So, I don't have a single number that one might want to look at, but I think if you looked at flows into fixed income funds, going into junk bonds, emerging market bonds, and perhaps leveraged loans. I think these were very high immediately following QE. I think in Europe, my favorite example has been just the quality of lending by Italian banks, because it's just happening on the balance sheets of their banks. My own experience with shadow banking is that it's almost like a little bit of like a Heisenberg's uncertainty principle, which is that the moment you try to define it too precisely, of course, the definition is not going to work anymore because, you know, it's just morphing into something else. So I just wanted to give a broader sense of what kind of things we might want to look for, but
Great. I'm going to ask a question, and then we'll look around the audience for other folks. It's for you, Morgan. So you identify basically this sort of externality, and there's an entry restriction that's the focus of your proposal. But I'm presuming you must have thought about a tax, right, which would be the other sort of classic way of dealing with that issue. And I'm curious what you view as the sort of pros and cons of those two sort of alternative ways of dealing with it.
Well, if it's a prohibitive tax, then I'm fine with it. I mean, if we do the 1865 version where you do a 10% tax and then it disappears. But more seriously, I'm a little bit skeptical of our ability to optimize some function here, and there's more at stake besides stability. I mean, I think the monetary control and seigniorage issues are very real, and so it's a bigger issue than merely stability. I'm not sure how much is okay. You know, I feel safe right now, we don't. You know, this funding model is certainly at low ebb today. I think that's it's partly the LCR, definitely, but it's partly just the interest rate environment. I mean, when and if the yield curve normalizes, if that ever happens, we're going to see tremendous pressure for it to come back. And I'm just not sure that we can say, I showed there were 15 trillion of claims on the eve of the crisis that were private and defaultable money claims. I don't know what the right number is, if 8 trillion would have been fine or not. I don't want to be dismissive of taxation, but I think the historical approach here has been to build a structural firewall, and I think it showed some success, particularly in the mid part of the 20th century.
Great. Okay. Yes. Just wait for the mic if you don't mind.
Oh, thank you. My first question is for Morgan. I'm afraid things might not be that simple, and they may be much more existential. On the one hand, you use money in the classic way as an outside commodity introduced into the market, into the economy, and on the other hand, you say that everything is down to this production of money. It does not add up. In that line of thought, money is not liquidity. Money is substitute for liquidity. If you see the Clarendon lectures that George Harman Moore, my colleague at Edinburgh and in other places, gave in 2001, and the whole theory that he has produced with Kiyotaki, is that liquidity is not money. Money is because we don't have enough liquidity. So I fear the two do not tally. And then, okay, money is something that's produced by the government outside the system. That means that everything from the last shadow bank in the world to the last fractional reserve bank has to become a narrow bank and issue no uncovered liabilities, no uncovered claims. Otherwise, how are you going to tally? How are you going to hedge the books? Which sounds to me pretty rigid. I don't say it's flawed, but it's like going back to the gold standard in life. Back then, was not as easy as people think. I know in the United States especially, there is this, again, philosophically existential or historical debate about private money, the second bank of the USA, and so on. But during the gold standard era, and during the time that the banks really had 50% reserves and were not creating money, gold was moving around the world. I mean, actual shipments of gold were shifting around the world, and all that was very deflationary. I wonder whether you want, I do not say that there is not an asset bubble, but I wonder whether you want to prick it to levels that will create Greek levels of depression or great depression levels of economic activity. So I'm not sure that's the way, even though complexity, and I will fully agree with you, is a systemic risk in itself, regulatory complexity. But there should be other ways, thinking about long-term policies, less liquidity into the system. And that brings me to my question for Sam. You know that deposit is a classic model, but doesn't exist. In the real world, what you have is loans, deposits, loans. Would your model work in the same way if we take that assumption into account, and also the fact that you have explained very, very well why if interest rates change, the shadow banking system will be in serious trouble. But wouldn't, in spite of structural reforms, wouldn't that trouble spill over, even though the banks say, you know, we should raise interest rates any day, deposits will stay low, we'll get some yield from assets. Wouldn't that spill over through the repo market?
Okay, so first Morgan and then Sam.
I mean, to some extent, this is semantic, right? What are we going to call money and not money? I think this moneyness premium that Sam and Jeremy have documented at the very short end of the Treasury yield curve, right? There's a kind of phase transition that comes inside in kind of the 6 month and in. Is something very real. And people seem to have demand for assets that have a very stable value in nominal terms, and what that means is short-term debt or money itself. So I'm using the term money to refer to that stuff also. Again, we could have a semantic debate about whether we could do that, but in a lot of contexts for a long time, people have used this terminology. And Jeremy and Gary Gorton and other distinguished observers use similar terminology. The question about deflationary and depression and et cetera, I mean, if our chartered banking system isn't producing enough money claims, if I can call them that, to satisfy money demand, then we're doing it wrong. We need, this is our chartered system to satisfy money demand, and if it's not working, then we should be designing it differently. But it doesn't seem to me obvious that for some reason the chartered banking system alone just couldn't generate enough, if that was the implication of what the question was. I mean, I'll repeat one more time what I said earlier, which is that 1933 until the mid-90s, the private runnable money market in the U.S. was extremely small. I mean, money funds arose in the late 70s. We had tri-party repo at some point in the 80s. There was a euro-dollar market that started to grow, started in the 60s, but wasn't that big until there was kind of an inflection point in the early mid-90s for reasons I'm not sure about. I think part of it is changes to 13.3 that happened at that point where we liberalized the U.S., the lender of last resort, but I could imagine other explanations. But I would just point out we had a very robust economy for many, many decades without a large runnable money market. It doesn't seem to me. I can't see any reason in principle why that couldn't happen again.
Sorry, could you just clarify? I didn't fully parse your question. You could.
I think that in spite of structural reform, there is still possibility of spillover risks from the shadow to the chartered banking sector, especially through the repo channel, and whether the fact that the maturity transformation model, the classic maturity transformation model is wrong. What you really have with QE, with wholesale lendings, loans, deposits, loans, and so on, whether, as a matter of fact, the chartered banking sector will be as affected as much.
Got you. No, so I guess my actual concern, my concern about the shadow banking system is less that the shadow banking system is going to collapse and impair the existing regulating banking system. It's more that the shadow banking system could be subject to a run. The real economy is vitally dependent on a flow of credit from the shadow banking system, and the regulated banking system is not able to quickly step in and fill the gap quickly enough. So, which in some sense is that's a kind of a thumbnail description of large parts of our crisis. So it's not necessarily, you could imagine completely severing the two so that there's no direct kind of domino effect from the shadow banking system to the regulated banking system, but you still would worry that you have this parallel version for credit that just completely shuts down. I mean, I would also be very concerned if the corporate bond market shut down for 9 months. Even if it didn't do a thing to banks. So.
Some of you made comments, I think Sam, you certainly did, and maybe Morgan, about risk moving from big regulated banks to non-banks or to small banks. So let's say activity moves from a $2 trillion bank to a community bank, or from a $2 trillion bank to some small hedge fund. Mm-hmm. And we want to be aware of that activity. If that does happen, wouldn't you argue that systemic risk has been reduced?
So, I think certainly, if it was activity migrating from a $2 trillion bank to a couple of $50 billion banks, totally. And to the extent that SIFI surcharges and things like that, to the extent that that's what they do, that they promote migration within the regulated banking system, but away from the kind of, the institutions that are of systemic importance on their own part. I think that it does make for a stabler, for a stabler financial system. What does worry me is when credit intermediation in the whole migrates out of the potentially out of the banking sector or out of the regulated sector in whole. So for instance, these alternative small business lenders, I'm not worried about them. I'm not worried about them from the kind of banking perspective that Morgan and I talked about, because they're not engaged in maturity transformation. They're financing themselves like an old-fashioned finance company. So it's just equity and long-term bonds. But to the extent that they have a market share in some particular local markets, to the extent that they were accounting for 50% of small business credit, and then suddenly they have a capital shock and their flow of credit becomes impaired, I would worry about that a lot.
But you wouldn't. I understand that. But would you agree that if it's some small credit provider, they may have market share in their market, but their own failure probably is not a systemic risk the way the original lender was.
Yes.
Now, and granted, small hedge funds can become very large hedge funds, so they could be long-term capital. Obviously, did pose a systemic threat to the U.S. economy. So it's not as though there's no possibility for that.
Yeah, I mean,
okay.
the best is in which there's a SIFI surcharge. It migrates, but it migrates and stays within the regulated banking sector. that's obviously the best.
Morgan, did you want to add anything?
I agree with the premise of the question, and that you're in a safer world when it migrates. I tend to think about this issue a little bit differently, though. My concern is not with where risk resides. I mean, I used to work at a hedge fund, and we took a lot of risk. It strikes me as a good thing to have hedge funds taking a lot. And I worked at a very big hedge fund. But as my remarks, I think, implied, what concerns me most is the funding model. And it's the migration of the funding model outside the regulated banking system that, to me, is of most concern. When we speak generically of risk or activity migrating out, I think most of us usually are thinking about the left side of the balance sheet and not the right side. I'm perfectly happy to have all sorts of risk migrate in terms of the left side of the balance sheet, migrate outside of the banking system. In fact, I think that's often a good thing. But it's when the funding model of what I will call money creation or money claim issuance, or you can call it maturity transformation if you want to. That's when I start to get concerned about migration.
So if I just say, I worry about asset risk migrating, but the funding risk model migrating, that gives me nightmares. So I think I agree with Morgan.
Yeah, Juanpa.
Yeah, this is for Samuel. I was thinking on your proposal of having a larger share of the government debt being short-term, and you were mentioning that in your work you found effects on both the rates and the growth of the shadow banking. Mm-hmm. But I was trying to get a sense of a quantitative sense of this, because my prejudice was that it would be small. Mm-hmm. But if we make counterfactual, if total government debt would have been 100% in short term by 2007, what would you told us that 70% of the debt was in the shadow banking. Mm-hmm. What that number would be if all government debt would have been 100% short term? So
we have estimates of kind of what this is, sort of what's the kind of crowding out coefficient, what is that elasticity. And I'll say a number. So it would be, every dollar of Treasury bills that you add might crowd out something like 40 or 50 cents of sort of financial paper. Okay, now that's being identified off of like very high frequency variation in the data. I would be a little bit more worried about kind of identifying whether you could actually extend that, to sort of a very broad scale. A very broad scale. We change the entire funding structure of these markets, but that's what it looks like at sort of high frequencies.
All right,
I can just add. So even though the question was not to me, so
you just have 1 minute.
1 minute, yeah. So I just wanted to mention that. So I find this idea of crowding out by government issuance very dangerous, because emerging markets have gone at it from the other side, and I think we could end up there, which is that they have wanted to crowd out private sector because the governments want to do everything. Because once the government thinks like that, they are the beneficiary of the liquidity premium in the economy. And the moral hazard that you currently have with the private system, you are transferring it to the government balance sheets. Now we have to ask about all sorts of fiscal checks and balances. Are they going to do it up to the right level? Once this is the way they start operating, at what point are they going to stop, etc. So I don't know. I find I think it's better to get at financial stability directly, in my view, rather than mixing fiscal policy with it. But that may be my.
So that's a good setup for the debate tonight, perhaps. With that, I'm going to turn it back over to Neil to conclude the meeting. Oh, I want to thank the panel. Yes, I'm sorry. I apologize.
Just, very briefly, I want to echo my thanks to all of our speakers and panelists today, and all of our participants here in the audience, at home, and the press who are here with us, playing a really important role getting this message out to people. So thank you all. This is our fourth symposium, and at literally every single one, I've learned a lot, and we've dug deeper and deeper and deeper into these issues. When we kicked this off in February, we didn't exactly know where it would go. We knew we would try to work together to come up with a plan by the end of the year. But we didn't know what that plan would look like, and this has really taught us and informed us and is shaping where we're going. when I think about regulatory reform, and this applies to bank regulation, it also, again, applies to terrorism, which I talked about earlier, we always look back and we ask ourselves, do our regulations correct for the most recent mistakes that we made? And then we hope that they will correct for future mistakes. Now, the future mistakes are usually different from the past mistakes, but at a minimum, the regulations should at least correct the past mistakes. And then hopefully they'll have some effect going forward. So let's look. I look at the current regulations. Let's look at it historically and let's look at it forward-looking. When I look historically, I think about our experience in 2008, and I ask myself, episode by episode, would this have helped us in Bear Stearns? Would this have helped us in Lehman Brothers? Would this have helped us in Fannie and Freddie? Would it have helped with AIG? And I think that the current regulatory structure fails the look-back test. TLAC, I've learned nothing over the course of this year that suggests that TLAC is going to work. And the burden is not on us to prove that it doesn't work, because basically all of recorded economic history suggests that it doesn't work. The burden is on those advocates who are proponents of it, saying why this time or the next time is going to be different. We heard from the earlier panel this morning how difficult it is to trigger the conversion from debt to equity in a crisis, huge uncertainty. And so I think that the proponents of TLAC are basically hoping and praying that next time is going to be different. But we haven't seen any evidence that it will be. And then looking forward, I think that a big vulnerability in the current regulatory structure is on its lack of emphasis around shadow banking. But the best guess is that the next crisis will look different from the recent crises or the past crises. And that means all of this activity in shadow banking is a huge vulnerability that is basically unaddressed by the current regulatory system. And so we do have to deal with past mistakes. We have to make our best effort to deal with future mistakes. And I think that, unfortunately, the current regulatory system fails on both of those tasks. And so what we're working on at the Minneapolis Fed is building on the discussions of these panelists to try to address both of those shortcomings that we see. And so, again, thank you all for participating. We've learned a lot. I've learned a lot today and from all of our symposiums, and we're excited about putting this together towards our plan, which we will release by the end of the year. And importantly, we're going to release it as we've done in a draft form, soliciting input from experts around the world so that we can incorporate the best views or the best minds and try to improve it. And then hopefully, folks will pick this up and take it forward. So thank you again. I'm assuming we're going to be gathering afterwards, maybe have a small reception afterwards. Happy to chat further. And thank you very much. Appreciate everybody's attention and participation.